Trading the dynamic financial market is never a boring affair. Just when you think you've figured everything out, it suddenly pulls an unexpected move on you. So how do traders cope with situations like that? One way is by using the straddle strategy. This strategy requires you to cover both sides of the trade. This may sound like you're hedging your trade, but the key difference between hedging and straddling is the fact that the former requires you to cover both positions. For example, put and call simultaneously or timed very closely together. With straddling, you are required to place your trade at its respective peak and bottom of the price trend. In this short video, we will see how this is done. Step 1. Identify an asset whose price movement is reaching an unsustainable point. You can use the Relative Strength Index, or RSI, to help you figure the overbought or oversold condition. You can access the RSI on the anyoption blog at anyoption.com. Remember, a reading of 70 indicates the asset is overbought and is due for a price drop, whereas a reading of 30 shows that the asset is oversold and the price is about to rise. Step 2. Let's assume that you have identified an opportunity in trading the US dollar Japanese yen. You determine that the price of the pair is likely to rise after a strong downtrend. To take advantage of this situation, you purchase a 30-minute call option priced at 104.69 at the bottom of the price trend. Step 3. As predicted, the price begins to rise not long after you purchased your call option. Unfortunately, you find the price movement more aggressive than you expected. Remember, all this is occurring within the 30 minutes expiry period of your call option. The fear here is that the price might peak within this time frame and then bounce back, resulting in your call option expiring out of the money. If the RSI shows a reading of 70 and above, this means the US dollar Japanese yen is now overbought and the price will likely reverse its course. As soon as the RSI reading reaches 70, purchase a put option for the US dollar Japanese yen and wait for the price to reverse its course. In our example here, we purchased a put option priced at 104.74. This way, you will be able to catch the upward movement of the price trend with your call option. If the expiry periods of both the put and call options are timed appropriately, you will find both trades expiring somewhere in the range between the put and call options. When this happens, both your trades will be able to close in the money. Take note that this strategy is situation specific and should only be applied in particularly volatile situations. Its main purpose is actually to minimize your losses, but applied correctly, it can also result in you doubling your profit. At the same time, you should bear in mind that there is also the possibility of both trades expiring out of the money. Happy trading!